Welcome to Junior Mining Gold, the podcast where we dig deep into the raw, unfiltered world of building fortunes from the ground up. I'm your host, Dusty Nugget, the guy who's ridden more boom and bust cycles than a rodeo cowboy on a bull named Recession. If you're new here, we don't sugarcoat the grind. We expose the guts of the business, from solo hustles to empire-building shares. Before we dig into the dirt, this episode is brought to you by juniormining.gold. Are you tired of missing the boat on the next big discovery? JuniorMining.gold is your ultimate radar for the high-stakes world of small-cap mining. We track the drills, the assays, and the movers so you don't have to. If you want the edge in the outback, head over to JuniorMining.gold. Now, let's get to the gold. Today is episode 2, and this one is very much an investor thinking out loud. 2 real companies, 2 real investments, 2 very different trajectories. One I'm actively adding to, the other I'm holding under a microscope, watching carefully and forcing myself to separate patience from denial. This episode isn't about who has the sexiest drill result or the flashiest headline. It's about people, structure, and whether a company is built to survive the next 5 years, not just the next news cycle. In mining, I firmly believe you need the right ground, but people matter more than rocks. Focus beats sprawl over the long haul. So here's the core tension we're exploring. One company is tightening execution and narrowing risk, while another is pausing, reorganizing, and testing investor patience. If you could only back one structure, not one stock, which one would survive the next 5 years? Let's unpack that by diving into these 2 companies side by side. Let's start with the company where structure is doing a lot of the heavy lifting. XXIX Metal Corp. That's 29, like the atomic number for copper. 29 didn't appear out of thin air. Its roots go back to 2018, when it was launched under the name PowerOre as a spin-out from OreCap Invest, the investment arm of Stephen Stewart's Toronto-based Ore Group. That origin story matters, because Ore Group isn't just a random collection of junior companies. It's essentially a mining incubator. Think of it like a startup incubator, but for mining projects, an ecosystem that builds companies from the ground up by sharing projects, people, capital, and governance know-how across the group. From day one, 29 benefited from that institutional memory and discipline. In plain English, 29 was engineered for growth rather than thrown together for a quick promotional pop. This wasn't some geologist wandering in the woods hoping to stumble on a shiny outcrop. It was a company designed as a builder, not a lottery ticket. That incubator DNA influences everything. It means decisions are made with a long game in mind. The founder, Stephen Stewart, is a mining financier and deal maker by background. He acted as a capital allocator, deal architect, and structure builder for 29, not a lifestyle promoter looking for his next paycheck. He lined up the pieces, projects, capital, people in a deliberate way. The company's very identity was shaped by that purpose from the start. One early move proved this engineered approach. 29, then PowerOre, secured the past-producing Opemiska copper mine complex in Quebec as its flagship project. That single decision set the tone. Opemiska wasn't a grassroots, maybe there's something here gamble. It's a brownfield asset, meaning a site that already produced metal in the past, so you know copper is in the ground. In fact, Opemiska had historically supported multiple small open-pit mines. The roads were there, power lines were there, a mining-friendly community was there. Most importantly, the geology was a known quantity. It had already proven it could host large volumes of copper. By choosing a brownfield, past-producing site, 29 immediately lowered the geological risk. This wasn't pure speculation. It was about building on something tangible. Now, quick sidebar for those new to the lingo. Brownfield exploration means you're working in the shadow of an old mine or known deposit. There's data, there's history, and usually some leftover resources. Greenfield means you're out there drilling in untouched ground, hoping to make an all-new discovery. Brownfield projects like Opemiska give you a head start because someone already found something there. Past production is like proof of concept. It drastically reduces uncertainty about whether the rocks contain valuable minerals. As the strategy sharpened, the company even rebranded to signal its focus. It first renamed itself QC Copper and Gold to highlight its Quebec copper focus, with a bit of gold. Then in 2024, it rebranded again as 29 Metal Corp, a nod to copper's atomic number, 29. That change wasn't just cosmetic or a marketing gimmick. It was a declaration of intent. They were telling the world, this company is about copper, and it's about scale. In other words, 29 was planting its flag as a pure-play copper developer, poised for big growth, not a mixed bag of random projects. Fast forward to today. 29 Metal Corp now owns 2 flagship copper assets in eastern Canada, both 100% owned, both past producing, and both chosen for their scale potential. Let's break those down. The Opemiska project in Quebec. This is the backbone of the company and the investment thesis. Opemiska is what got me interested initially. It's a large property that hosted several former copper mines. When 29 took it over, they had a clear vision: apply modern exploration methods to uncover more copper around and below the old mine pits. And that's exactly what they've done. Years of drilling have confirmed that copper mineralization extends well beyond the historical pit boundaries and continues at depth. We're not talking about a few high-grade veins here and there. We're talking broad zones of continuous mineralization. Its resource estimate includes 1 billion pounds of copper, 4 million ounces of silver, and almost 700,000 ounces of gold. That continuity is key because it could support a large-scale, long-life mining operation rather than a short, hit-and-run mine. In fact, 29 recently completed an economic study, the kind of report that assesses project viability. Think of it as a preliminary business plan for a mine. The results: $900 million net present value and a 39% internal rate of return, indicated that Opemiska could potentially support 17 years of production under reasonable assumptions. Now, an economic study, often a preliminary economic assessment, isn't a guarantee of success. It's not as detailed as a full feasibility study, but it's a significant de-risking step. It basically says, given what we know so far, this project makes economic sense to pursue further. It's a reality check that uses real data on grade, tonnage, costs, and prices to show potential profitability. So the takeaway from Opemiska's study was not, yay, quick flip for a promo. It was, hey, this could be a legitimate long-life copper mine. That's a big deal in this industry. Why? Because long-life copper projects in stable jurisdictions like Quebec attract a very different audience. Read, bigger fish with deeper pockets. Copper is a strategic metal. If you believe in the global push for electrification, power grids, electric vehicles, renewable energy infrastructure, then you know demand for copper isn't going anywhere but up in the long term. Projects like Opemiska start to look like crown jewels because they could feed that demand for a generation. In other words, Opemiska is the kind of asset that might eventually land on the shopping list of a major mining company that needs to secure future copper supply. The Thierry project in Ontario, the second engine in 29's portfolio. Thierry is another past-producing copper and nickel mine located in northwest Ontario. 29 acquired Thierry in late 2024 through an all-share acquisition of another company, which, conveniently, was also within the OR Group ecosystem. This means they were able to fold in a second large copper project without shelling out cash or courting a hostile takeover battle, a friendly deal thanks to their network. Thierry is historically significant. It was once Ontario's largest copper mine by resource size. It produced about 5.8 million tons of ore back in its day, grading around 1.1% copper plus some nickel before it closed. That historical production reinforces that Thierry's geology works. Mother Nature put a lot of copper there. Now, Thierry today is like Opemiska's younger sibling in terms of development stage. It's earlier in the redevelopment curve, meaning it will need more drilling and studies to fully realize its potential. But it offers something just as valuable as Opemiska's long history: sheer scale. The known mineralization at Thierry, from both past mining and recent validation work, suggests a large resource base, 500 million pounds of copper that could grow with further exploration. In practical terms, Thierry gives 29 optionality and a second growth pipeline. Opemiska alone can carry the story as a robust development project. Thierry adds upside, a chance to either develop a second mine in the future or even to interest another partner or buyer down the line. It's like having a backup quarterback who could also be a star player given the chance. Importantly, acquiring Thierry the way they did means 29 didn't dilute their focus or treasury to get it. It was a strategic bolt-on. Both their key projects are in eastern Canada, which simplifies things. The company isn't scattering its attention all over the globe. That geographic concentration means management can leverage the same regional expertise, relationships, and infrastructure for both projects. Focus and simplicity, we like that. There's another subtle but telling aspect of 29's portfolio management. They know what not to own. Case in point, earlier on, the company had some non-core gold assets kicking around, the legacy of when it was called QC Copper and Gold. But rather than chase two rabbits, copper and gold, and risk catching none, they chose to monetize those gold assets. They sold or spun them out via share deals within the OR Group family. In doing so, 29 kept a bit of upside exposure through shares in those other companies, but freed its management and treasury to focus exclusively on copper. That is a masterclass in discipline. It's not flashy to tell people, we sold something and now we have one less project, but honestly, in the junior mining game, knowing what to drop is as important as knowing what to pick up. Every project you hold has an opportunity cost. 29's team understood that, and they trimmed the fat. I always say restraint is a competitive advantage in this sector. Distraction kills more junior companies than bad geology ever will. By shedding the SideQuest gold projects, 29 made it clear to investors, we are a copper company, full stop. That clarity of purpose is worth a lot, and the discipline will pay dividends, figuratively speaking, as the company moves forward. Remember, discipline compounds over time. Now let's talk about management, because this is where 29 really shines in my book. A company's structure isn't just the assets and shares, it's also the people at the helm and whether they fit the task at hand. 29 nailed a key transition that many juniors fumble. Here's what happened. Stephen Stewart, the founder I mentioned, guided the company through its formation and early exploration phase. He's excellent at that role, assembling assets, raising capital, and leveraging his network, the OR Group, to set the company up. But in 2025, as 29 was graduating from pure exploration into the development stage, after that economic study on Opemiska signaled its go time for project advancement, Stewart did something all too rare among junior mining founders. He stepped aside as CEO. He didn't leave the company high and dry. He moved into the executive chairman role where he can still contribute strategically and support big-picture goals. But for the day-to-day execution and the next phase of growth, 29 brought in a new CEO, Guy Le Bel. Now, Guy Le Bel is not your typical promote-and-hope junior mining exec. He's a seasoned mining engineer with over 30 years of experience, including senior roles at notable mid-tier and major companies. Think Capstone Mining, Quadra FNX, and others. In other words, he's a builder, someone who knows how to take a project through studies, permitting, financing, and into actual production. This was a stage-appropriate leadership change. Explorers and builders are different breeds. It's one thing to be great at finding and defining a resource. It's another to turn that resource into a functioning mine and cash flow. By bringing in Le Bel, 29 matched the skill set to the company's evolving needs. Meanwhile, to keep continuity, they also promoted from within on the technical side. Dennis McNichols, a geologist who had been intimately involved with Opemiska's exploration, was elevated to vice president of exploration. That move ensured that even as the company shifts toward development, it's still guided by the technical knowledge and culture that got it this far. So the founder remains involved at a high level, the exploration brain trust is retained and recognized, and a veteran engineer takes the wheel as CEO. This is textbook succession planning in the junior mining world, and it's often a bullish sign when done right. Why bullish? Because it shows the company isn't a one-man show or a personality cult. It's evolving beyond the founder's ego for the sake of the project's success. Stephen Stewart effectively said, I've brought this company to a juncture. Now I'm handing the keys to someone who can drive it to the finish line. That gives me confidence. It tells me this is a company that's serious about execution, not just promotion. Continuity without stagnation, the best of both worlds. So where does that leave 29 Metal Corp right now? And why am I personally still adding to my position here? In short, 29 has set itself up as a focused copper developer with a clear path forward and a structure built for success. The economic study on Opemiska I mentioned is done, and it likely showed robust numbers that justify advancing the project. They are effectively transitioning from being an explorer, drilling to see what's in the ground, to a developer, actively planning how to turn the known resource into a mine. This transition is critical. It's the point where many juniors either make it or break it. For 29, all signs point to them making it, because they've methodically de-risked things along the way. Let me unpack a couple of those de-risking elements. First, the capital structure of the company is relatively simple and clean. They haven't blown out their share count to ridiculous levels, and they aren't saddled with toxic debt or countless royalty obligations. With 300 million shares outstanding and 13% insider ownership, they have a market capitalization of about $30 million. That means, as an investor, you don't have to worry as much about convoluted financing tricks or massive dilution out of nowhere. Second, they have clearly sequenced milestones ahead. This is a company with a roadmap. For example, they indicate they will deliver a pre-feasibility study by the end of 2026 for Opemiska, and will continue drilling there through the first half of the year. And they will continue advancing environmental and community engagements in Quebec, which is mining-friendly, but you still have to do the legwork. In fact, they hosted a town hall in December 2025 to review the PEA with local stakeholders. They might also do some work on Thierry to keep adding value there, but likely without detracting from Opemiska's timeline. The point is, they've communicated, both in reports and by their actions, what the next few steps are. There's a logical progression. De-risk, add value, de-risk more, add more value. I often refer to the development stage of a mining company as the execution decade. It can literally take the better part of a decade to go from a promising study to an operating mine, especially in a responsible, measured way. That period tends to be less flashy than the exploration phase. No wild high-grade drill hits that make the stock double overnight, but it's where a lot of real value is created. It's also where a lot of juniors falter because execution is hard. But 29 is entering this phase with all the right pieces. A flagship project with scale in a safe jurisdiction, a second project as backup, upside, a strong and relevant management team, supportive insiders. The ore group folks own meaningful stakes, so their interests are aligned with regular shareholders, and enough focus and funding to carry out the plan. Importantly, they aren't relying on constant speculative news to keep the story alive. They're relying on advancement and de-risking. Each milestone they hit, like completing a feasibility study, signing a partnership, or securing permits, will lower the risk and ideally increase the project's value in the eyes of bigger players or long-term investors. This is de-risking, not hyping. As an investor, I find that far more attractive for a core position. All that is why I'm still confidently adding to 29. To sum it up, I see a focused copper thesis, 2 brownfield assets with demonstrated scale, Opemiska now, Thierry brewing for later, a clear development pathway for the lead project, optional upside from the second project, a simple share structure, meaningful insider ownership, and leadership that has evolved appropriately with the company's needs. 29 is structured for success, and they are actively executing. In a tough market, they've managed to keep delivering results and maintaining momentum. It's the kind of junior miner that I believe is built to survive and prosper over the next 5+ years, not just survive the next drill assay. Now, before we move on to Company 2, let's pause and highlight why I'm telling you 2 stories side by side. You might be thinking, Dusty, you seem to like both of these companies, so why not just say they're both good? Here's the thing. 2 companies can both have merit, good projects, good people, but that doesn't make them equally investable. In junior mining, the way a company is structured and managed can make all the difference in whether it rewards shareholders or not. This segment is about resetting expectations and framing the contrast we're about to see. Consider what we just heard about XXIX Metal Corp. It has institutional discipline from its incubator origins, a tight focus on one commodity in one region, and a clear hierarchy of what matters. Opemiska first, Thierry second, everything else a distant third or gone. It's not chasing 10 things at once. It's executing on one big vision with optionality on the side. Now compare that conceptually to a company that might have a ton of opportunities, so-called optionality, but without a clear hierarchy or priority. Optionality can sound sexy. Look at all the projects we have. Any one of them could be huge. But optionalities without a dominant priority often lead to drift. If everything is important, then nothing is truly important. Without a center of gravity, a junior can spin around in circles and investors get dizzy and lose interest. We're about to discuss BeMetals Corp, the second company. BeMetals has something 29 never had: institutional backing from a major mining company. That comes with big advantages: credibility, access to capital, technical support, basically a nice safety net. But what I want you to consider as we go through BeMetals' story is the difference between having a safety net of capital and having a disciplined structure and focus. One is about having resources available, the other is about using resources effectively. It's money versus method. Ideally you want both, but if I had to choose, I'd pick method every time. Because as an investor, I'd rather back a company with $5 million and a great plan than one with $50 million and no clear plan. So keep that in mind. This isn't a tale of good company versus bad company. It's a study in contrasts: focused development versus diversified exploration, roadmaps versus optionality, capital discipline versus capital availability. Both companies are run by smart, experienced people. Both had solid potential from the start. But their trajectories diverged because of structural choices. And that leads to different standards when we evaluate them. So let's switch gears and examine Company 2, because in contrast, the lessons here will really sharpen into focus. The second company is BeMetals Corp, and right from the outset, this story is all about pedigree and ambition. BeMetals was founded around 2018 as well, but instead of coming out of an incubator, it emerged from the minds of some heavy hitters in the mining industry. I'm talking about former executives of B2Gold and its predecessor, Bema Gold, companies that have built multiple mines and made shareholders a lot of money over the years. The founding chairman and major influencer here is Clive Johnson, the CEO of B2Gold, a major gold producer, and formerly co-founder of Bema Gold. Alongside him on BeMetals' board were people like Tom Garrigan, a renowned geologist, and Roger Richer, among others, essentially a team with decades upon decades of experience in discovering, developing, and operating mines across the globe. That kind of track record and name recognition gave BeMetals instant credibility in the market. When they launched, people paid attention. It's not every day a junior is backed by folks who've discovered world-class deposits and built multi-billion-dollar companies. And it wasn't just moral support. B2Gold Corp itself became a strategic investor in BeMetals. Over the years, B2Gold put money into BeMetals through multiple financings. They even showed extraordinary support by converting a debenture, basically a loan, into equity and forgiving some debt outright to clean up BeMetals' balance sheet. By late 2025, B2Gold had accumulated roughly a 37% ownership stake in BeMetals, making them by far the largest shareholder. In essence, BeMetals has had the long-term backing of a major producer's checkbook and expertise. Today, BeMetals is a $16 million market cap company with 240 million shares outstanding. Let's unpack what that means. When a major backs a junior, it typically means the big company sees strategic potential. Maybe they want a foot in the door on a promising project, or they believe in the junior's team to eventually deliver something worth buying. For the junior, it usually means easy access to capital. B2Gold's participation ensured BeMetals was funded when many other juniors struggled, and a sort of halo effect of credibility. If a top-tier company trusts them, maybe we should too. It also can mean technical support. Majors can second geologists or engineers to help, or just be a sounding board. However, one thing to clarify, a strategic investor is not the same as an owner-operator. B2Gold's backing gave BeMetals optionality and a safety net, but operational control and day-to-day decisions remained with BeMetals management. The major didn't take over the show. They let the junior do its thing, at least up to now. That's important. It means BeMetals had a lot of rope, which can be used to climb great heights, or, if one is not careful, to hang oneself. Now, BeMetals' corporate DNA and vision from the start was different from 29's. Whereas 29 was laser-focused on one commodity, copper, in one country, BeMetals was conceived as a globally diversified exploration platform. Think big and broad. Copper in Africa, gold in North America, gold in Asia, all under one small company's roof. The logic was that this team had global experience and could sniff out high-impact opportunities anywhere. And with B2Gold behind them, they had the funds and the network to pursue multiple initiatives at once. It was almost like the inverse of 29's incubator model. Instead of one group spawning multiple single-focus companies, here one company held multiple projects of different flavors and locations. BeMetals was positioned as a platform company. Not a single asset story, but a mini portfolio of projects, any one of which could be company-making if successful. It's the shots on goal approach. Take several shots so that you improve your odds that one will score big. There's wisdom in that approach, especially if you have the talent and money to execute. But there's also a potential pitfall, managerial bandwidth. Even a dream team has only 24 hours in a day and a finite amount of attention. Running far-flung projects simultaneously is a challenge, operationally and strategically. It demands A-plus project management and an ability to continually prioritize and pivot. Keep this in mind as we go through BeMetals projects. They had a lot of shots on goal, but each one requires time, money, and focus, and juggling them is an art. Let's dive into what BeMetals actually owns or has owned, because it's quite the spread. It starts with Pangeni Copper Project in Zambia. This has been BeMetals' marquee project on the copper side. Pangeni is an early-stage exploration project, but it's sitting in a highly prospective neighborhood, the Zambian Copper Belt, not far from where giants like First Quantum operate big copper mines. The allure of Pangeni is the target type. They're looking for large, disseminated copper deposits undercover. In simpler terms, they're not looking for a narrow vein you can miss with the drill. They're looking for a big bulk tonnage system, something that could potentially support a massive mine if it's there. The catch? The copper is not sticking out at surface. It's concealed, so they have to drill blind targets guided by geophysics and subtle geochemistry. That takes a lot of drilling, data, and patience. BeMetals made a smart strategic move here by bringing in a partner to share the risk. They partnered with Japan Oil, Gas, and Metals National Corporation, JOMEC, a Japanese government-backed resource agency, which funded a considerable portion of the exploration at Pangeni in exchange for a potential stake. This is essentially a joint venture. In everyday language, we'll team up, you, the partner, pay a bunch of the exploration costs, and if we actually find something worth developing, you earn a piece of the project. This kind of deal is great for a junior. It lets BeMetals chase an elephant-sized target without risking all their own cash on a single long-shot bet. And if Pangeni hits the jackpot, both BeMetals and the partner win big. So Pangeni represents the high-risk, high-reward copper upside in BeMetals' portfolio, intelligently de-risked by external funding. On the gold front, one notable project has been Savant Lake in Ontario, Canada. Savant Lake is an early-stage gold exploration project in a region that has geological similarities to some prolific gold camps. For those familiar, think Red Lake or Musselwhite regions. For the layperson, that means the rocks have the right ingredients for potentially hosting a gold deposit, but it's still very much an exploration play, meaning they have to find that deposit through drilling. BeMetals optioned this project, meaning they have the right to earn up to 100% ownership by spending money on exploration and making some payments. Savant Lake is interesting because if they were to hit a significant gold discovery there, it could re-rate the stock in a hurry. It's that kind of pure exploration, discovery leverage that many investors crave in juniors. The chance that one drill hole can change the fortune of the company overnight. It complements the longer-term Pangeni story by adding a nearer-term, more classic high-grade gold drill play to the mix. However, until a discovery is made, Savant is also an if. It's about potential rather than proof. BeMetals also ventured into Japan for gold exploration, which is a frontier that's been opening up recently for foreign juniors. They acquired or partnered on a couple of projects, like the Kato project, later renamed. Japan is a place with great geology. The high-grade Hishikari mine is world famous, but it's also a place with challenging bureaucracy, and where local partnerships are crucial. After some initial work, BeMetals made another disciplined decision. They farmed out their Japanese projects. In 2023, they struck a deal with another company to take on one of the Japanese gold projects, and as we saw in a recent update, they secured an agreement to option part of their interest in the Kazan gold project portfolio as well. In practice, this means BeMetals' partner will fund and advance exploration in Japan, while BeMetals retains an equity interest or royalty in whatever comes of it. It's a similar philosophy to the Pangeni JV. Let someone else spend the high-risk dollars, while you keep a foot in the door in case of success. This move acknowledged that BeMetals' core team and cash are better used elsewhere, given Japan's slow permitting and the fact that it's far away both geographically and operationally. I give them credit for this. It shows strategic focus by pruning the project list and not trying to do everything everywhere at once. Earlier in its life, BeMetals also had a base metal project in Idaho, USA, the South Mountain Zinc-Silver project, which it was earning into. That actually delivered decent drilling results and an updated resource at one point, but it hasn't been the frontline story in recent times. They may have deprioritized it in favor of the projects above. The outline of our discussion doesn't emphasize it, which suggests it's not a current focus. The fact that it's not front and center implies management is concentrating on Pangeni and Savant Lake primarily, which again shows some recent tightening of scope. Now looking at this portfolio as a whole, copper in Africa, gold in Canada, some legacy base metals in the USA, and some optioned-out gold in Asia. That's a lot of breadth for a junior. The positive spin is, as I said, multiple shots on goal, diversified commodity exposure, copper and gold, and diversified geographic exposure. So if one country's politics go bad, you have other options. The negative spin is that it can be tough to maintain a clear narrative and efficient execution with so many moving parts. Let's talk about that narrative clarity. If you were to ask, at various points in time, what is BeMetals' flagship? What's the one thing I should watch as an investor? You might have gotten different answers. Some might say Pangeni, the potential company maker copper play. Others might say Savant Lake, the exciting high-grade gold hunt. A year or two ago, someone might have said the Japanese projects, or even the Idaho project. When a company's story is spread out, investors can get confused or lose patience. Did breadth dilute the story? That's the question. In my view, yes, to a degree. The ambition of doing many things meant BeMetals didn't establish a single, strong center of gravity like 29 did with Opemiska. They have a lot of potential greatness, but no single project has yet matured enough to undeniably define the company's value. To be fair, management wasn't naive about this challenge. They tried to balance it by risk-sharing, joint ventures and farm-outs, and by keeping investors updated on multiple fronts. And the truth is, each project individually has merit. I want to stress that. Pangeni is exactly the kind of target a major would want in its pipeline if a discovery is made. Savant Lake is the kind of place a new gold discovery could happen in an underexplored district. Farming out Japan was the right move, so the decisions on each asset level have been pretty sound. But in the stock market, you can have a collection of good projects and still not have a great stock if the market isn't sure what to make of your identity. Remember, investors can't revalue what they can't categorize. BeMetals, through its growth, became a bit hard to categorize. Is it a copper play, a gold play, an Africa story, a North America story, a prospect generator model with all these JVs, or a would-be developer? It had elements of all the above. Now, let's move to the management and recent leadership changes at BeMetals, because this is a critical chapter of the story. For most of BeMetals' life as a public company, the CEO was John Wilton, a geologist with extensive experience, including in Africa, which made sense for Pangeni. He led the company from inception through the assembling of that project portfolio and the initial exploration programs. The board, as we discussed, was stacked with heavyweights like Clive Johnson, and they were guiding big-picture strategy. This setup worked well enough to advance projects, and certainly to keep the money coming in from B2Gold. However, by 2025, the company still hadn't delivered a defining win. There was progress, but not that home run that crystallizes the value of one of the projects. And in September 2025, John Wilton resigned as president, CEO, and director of BeMetals, citing personal reasons. His departure marked a significant inflection point. Anytime the founding CEO or long-tenured CEO of a junior steps down, it forces a reassessment. Is this an orderly transition to new leadership for the next phase, or is it a sign of trouble, or simply burnout? The company handled it in a very matter-of-fact way. They appointed Kristen Reinertsen, a director and corporate secretary of BeMetals, as the interim CEO, while the board searches for a permanent new chief executive to spearhead BeMetals' corporate strategy, as they put it. Kristen is actually a founding director of the company and has a strong background on the corporate side, finance, governance, etc., with 18 years' experience in resources and tech. So she's not a random placeholder. She's deeply familiar with BeMetals. Also, notably, the board of directors, including Chairman Mark Connolly and Director Clive Johnson, remained in place and vocal about their ongoing support and vision for the company. In the press release announcing the changes, the board gave a clear message. They talked about a refreshed corporate strategy, focusing on advancing high-quality exploration and development projects in North America and unlocking value from the existing portfolio. They specifically highlighted the strong assets, the top-tier board, and the continued support of B2 Gold, expressing confidence that BeMetals is well-positioned to deliver on its strategy and create long-term value. Let's read between the lines a bit. The emphasis on North America suggests a tightening of geographic focus, perhaps saying, all right, let's prioritize our backyard projects, like Savant in Canada, maybe an Idaho asset if still relevant, for now, while we continue with Pangeni, but don't take on anything new far afield. The mention of unlocking value from the existing portfolio hints that maybe certain projects could be monetized or spun out if they're non-core, basically the kind of cleanup and focus we saw XXIX do with its gold assets. These are signals of institutional discipline asserting itself. The board and B2 Gold didn't abandon ship. On the contrary, they effectively doubled down by cleaning up the balance sheet and publicly recommitting to the company. But they're also implicitly acknowledging that things need to change to get the market to recognize the value here. From an investor standpoint, a CEO change is a moment of uncertainty, but also potentially a catalyst for positive change. It can go either way. The truth is, leadership transitions are neutral events until proven otherwise. By that I mean, just swapping the person at the top doesn't inherently create value or destroy it. It's what the new leadership does, or fails to do, next that matters. It's an inflection point. Either the company finds a renewed focus and momentum, or it continues to drift or even deteriorate if the transition is poorly handled. In BeMetals' case, having an interim CEO suggests the board didn't have a hand-picked replacement ready to go, which is a sign that Wilton's departure might not have been long planned. That could indicate a bit of scrambling, but the silver lining is that the interim leader is an insider who knows the story, so it's more of a keep the ship steady move than a radical shift. The continued backing of B2 Gold at this juncture is hugely important. B2 Gold essentially wiped clean any near-term financial stress by converting debt to equity and likely ensuring BeMetals has the cash to continue its work for a while. That means the new or interim management doesn't have to immediately worry about fundraising in a tough market. They can focus on strategy and execution. However, I'd argue that at this point, the crutch of having a wealthy patron can only go so far. The market, and likely B2 Gold too, will want to see real progress on the ground. The pedigree and money saved the day through the lean times. Now it's time for that pedigree and money to translate into tangible results. To sum up the current leadership situation, BeMetals still has a heavyweight board and major shareholder support. Those are big positives few juniors have, but it also has a bit of a leadership void, or at least a leadership question mark, until a permanent CEO with a clear vision is installed. The interim period needs to be one of action, not just caretaking. This is the chapter where BeMetals has to prove it can go from being a promising collection of assets under a legendary banner to being an actual focused execution story like 29 has become. So where does BeMetals stand today? And why am I, as an investor, in hold and watch mode rather than buying more? In many ways, BeMetals is a story of unfulfilled potential, so far. Let's look at the key elements. Assets. They've got promising projects, Pangeni, Savant Lake, etc., but none has delivered a knockout result or a defining resource yet. There's a lot of option value here, meaning if any one of these projects hits big, the stock could run hard. But option value isn't the same as realized value. Until something is discovered or advanced to an economic study, it remains a maybe. Backing and financials. They have a clean balance sheet now, thanks to B2Gold's interventions. They have cash to continue exploring, and with 37% owned by a major, there's an implicit support for future financings if needed. So financially, they're stable, which is more than can be said for many juniors in the current market. That's a strength. It means they can be patient. But on the flip side, patience has a cost. Every month or quarter that goes by without a major breakthrough is time for investor enthusiasm to fade and for the opportunity cost of that capital to tick up. Holding a stock that isn't moving while other opportunities are out there means you're effectively losing potential gains elsewhere. Market sentiment. I'd say the market currently is in show me mode with BeMetals. The pedigree and backing gave them a pass for a while, a sort of benefit of the doubt. But as years passed without a flagship discovery or development, the stock hasn't performed particularly well, especially relative to many peers, or to 29, for example. There's a bit of investor fatigue, a sense of, okay, you have all these great pieces, but when will the puzzle come together? The leadership change and talk of refocusing have likely put some people in wait-and-see mode, myself included. Given all that, here's my dilemma as an investor. I still believe in the potential of BeMetals' assets, and I respect the heck out of the people involved. I mean, having B2Gold in your corner is not trivial. If, say, the Pangeni project starts hitting significant copper, you can bet B2Gold could quickly pour more resources in or even strike a deal to take it further. The upside scenario for BeMetals is very real. However, belief in potential is not a sufficient reason to keep buying more stock. At some point, you need evidence of momentum and value creation. For me, BeMetals is in that prove-it phase where I'm holding my existing position, because I don't want to abandon that upside, and I do trust the people involved to try and get it right. But I'm not adding more money to it right now. I'm effectively saying, okay, BeMetals, ball is in your court. Show me something that reignites conviction. What would that something be? There are a few possibilities that I and many investors will be looking for in the coming months. A clear flagship emerges. If BeMetals comes out and clearly designates, say, Pangeni is now our primary focus and here's why, or Savant Lake is the near-term driver and we're putting most of our capital there, that would help a lot. Right now, the company has talked about focusing on North America, which implies Savant, Gold in Ontario, might take center stage while Pangeni continues with partner funding. If I see concrete evidence of that, like budget allocations or drill plans heavily skewed to one priority, it will signal the company is truly establishing a center of gravity. That would increase my confidence. Tangible exploration success. This is the obvious one. A great drill hole or a resource estimate that finally gives the market something to sink its teeth into. For example, if they drill a barn burner at Savant Lake, like a thick intercept of high-grade gold, or if the next season at Pangeni outlines a large zone of, say, 0.5% copper over hundreds of meters, indicating a potential deposit, that would be a game-changer. It doesn't even have to be an economic discovery yet, just something clearly on the path to one, an unambiguous technical success that proves one of these projects is the real deal. Strategic moves. Another catalyst could be if they monetize or spin out a non-core asset. Suppose they sell the Idaho project or package the Japanese royalty into a sale and use those funds to extend drilling on the main targets. That would show focus and could bring in additional investors who like seeing juniors being proactive in creating value beyond just drilling. Or, if B2Gold's involvement escalated, like B2Gold says, we're going to directly fund a big program at Pangeni this year because we're encouraged. That external validation could also wake the market up. New leadership and vision. And of course, a lot rides on who becomes the permanent CEO. If they appoint someone with a strong track record of turning projects into mines or discoveries into deals, and that person lays out a crystal-clear strategy, that could be the fresh start the market needs to give BeMetals a second look. Conversely, if we're in mid-2026 and there's still an interim CEO, no decisive progress, and the messaging is still a bit of everything for everyone, then my patience will start running out. I'll be honest, I'm willing to give BeMetals some time, partly because that B2 Gold backing means they have the time, they won't vanish overnight, and partly because I know big discoveries or turnarounds can sometimes take longer than you think, then happen all of a sudden. But I'm also monitoring very closely for signs of real momentum. If another year passes with no clarity and no breakthrough, I'd have to seriously consider reducing or exiting the position. Not out of spite, but because dead money is dead money, and I owe it to myself to allocate capital where it's working. On the flip side, if BeMetals shows me real progress and focus, say by hitting a milestone or at least demonstrating a tight game plan, I could see my conviction returning and even adding to the position. It's one of those situations where I'm not married to the stock. I'm dating it, waiting to see if it shapes up into the kind of long-term partner, investment, I want it to be. Now, I want to do something a little different here. Instead of just waiting passively to see what happens, let me outline what I think BeMetals needs to do next to regain investor confidence and realize its potential. Think of this as unsolicited advice from an investor who genuinely wants them to succeed. This isn't just for BeMetals. These are principles any junior in a similar situation should consider. What BeMetals needs to do next. First, translate that refresh strategy into a concrete timeline. It's great to refocus on paper, but we need it in practice. Momentum is about direction, not just speed. BeMetals should lay out a simple roadmap for the next 3, 6, 12 months that investors can follow. For example, in the next 3 months, we'll complete X drill program at Savant Lake to test Y targets. In 6 months, we expect to have results and make a decision on follow-up or shifting focus. In 12 months, we aim to have defined a maiden resource or moved on from the project. We need decision gates, not vibes. It's totally fine if some outcomes are negative. If in 6 or 12 months a project doesn't pan out, that's okay if it leads to a decisive action. Drop it and move resources to the next thing. But tell us that up front. Here are the checkpoints and what we plan to do at each. And tie the budget to those checkpoints. Dollars should be clearly tied to specific goals and learning outcomes. Instead of, we have a general exploration budget for multiple things. Say, we're allocating $2 million to drill 5,000 meters at Project X by Q2, which will answer this key question. If results are positive, we'll do A. If not, we'll do B. That kind of clarity is gold for investors because it turns nebulous potential into a series of near-term events we can watch and evaluate. Second, demonstrate real leadership during the interim period. Just because the CEO title has interim in front of it doesn't mean the company should act tentative. In fact, this is the time to double down on communication and execution to show that the organization is strong even as it transitions. That means we need to see real decisions being made now, not just deferring everything until a new CEO comes. Kristen, the interim CEO, and the board need to project confidence and purpose. Fewer but clearer updates, consistent messaging, no mixed signals about what's important, and holding the line on spending for anything that's not priority. If I start seeing press releases like, BeMetals does small work on Project X, Y, Z unrelated to core focus, I'd be concerned. Instead, I want to see something like BeMetals appoints key technical advisor to drive Project A forward, or BeMetals secures partnership to fund Project B while it concentrates on Project A, or even just BeMetals completes milestone at Project A ahead of schedule. Also, clarity on the timeline for hiring a permanent CEO would be reassuring, e.g., we expect to appoint a new CEO by Q3 2026, or the search is underway with excellent candidates. In absence of that, there's always the lurking fear of leadership drift. The board does remain a huge asset. These folks have seen it all before, and now is exactly when their guidance should be most evident. They can't be shy. In smooth times, a great board is nice window dressing. In times of change, a great board should be front and center, preventing chaos and keeping the ship on course. Third, show discipline in project count. I mentioned distraction being deadly, so this is about proving that the project list is finite and controlled. BeMetals should explicitly categorize their projects, which ones are active, getting money and work now, which ones are passive, held in the portfolio but on the back burner, maybe waiting for better markets or a partner, and which ones are candidates for exit, to be sold, JV'd, or dropped. And here's a rule I'd love them to commit to. No new projects unless they either have full funding from outside or they replace an existing project. In other words, don't add another dish to the menu until you've cleared one off. A lot of juniors can't resist picking up one more promising project. It's like a shiny object syndrome. But BeMetals has enough on its plate. Execution now is about narrowing and deepening, not widening. If they can publicly and internally commit to, say, we will focus on these 2 or 3 projects, and everything else is secondary or available for monetization, then investors can relax about the worry that, oh no, they're going to dilute focus again by acquiring some new play in, I don't know, South America or something. Saying we're focused isn't enough. Show us through actions, and even through how you allocate time in your presentations and news releases. Restraint is not weakness, it's professionalism. Fourth, turn that major shareholder backing into a clear advantage, not just a safety net. As I said, safety net capital is not the same as growth capital. Just having money in the bank, or a rich uncle in the wings, doesn't automatically create value. It's what you do with it. BeMetals should leverage B2Gold's involvement in more tangible ways. For instance, perhaps involve B2Gold's technical experts directly in vetting and high-grading the project pipeline. Let the world know that B2Gold's exploration team has reviewed our plans, and here's why they're excited, if that's indeed happening. Or set clear success triggers for deeper B2Gold involvement. Maybe an understanding that if we delineate X tons of copper at Pangeni, B2Gold might farm in further or take an even larger stake. Basically hint at the path to a potential takeover or JV. Right now, B2Gold's stake is passive from an outsider perspective. It would instill confidence to see a more active synergy. The majors' backing should also help on things like ESG and community relations. Majors have whole departments for that. Use it. Brag about it. Show that having a company like B2Gold on your roster isn't just for show. It's accelerating your progress. If all the backing does is keep the lights on, then it's being underutilized. We want to see that backing translate into faster or more effective exploration and development. Fifth, and this is critical, deliver one unambiguous technical answer. By unambiguous, I mean design and execute a work program that yields a clear result, one way or the other. This could be a drill campaign on a single target that's comprehensive enough to tell us, yes, there's a viable deposit here, or no, there isn't, at least not the kind we hoped. For example, commit to testing the most prospective part of Pangeni with enough drilling to either hit a known scale of mineralization or rule it out. Or at Savant Lake, drill those high-priority geophysical anomalies thoroughly to see if they're gold-bearing or just geologically interesting duds. The worst outcome for a junior and its investors is to spend years in a loop of encouraging but inconclusive results. Always smoke, never fire, but never definitively walking away either. It's like being stuck in exploration purgatory. I'd rather see a company take a big swing and miss and then move on to the next target than perpetually bunting and never trying to score. Progress in this business is resolved uncertainty. Even a failure is progress if it leads you to redirect resources to the next thing. BeMetals needs to break any cycle of partial answers. Give us one binary outcome. Did we find something significant? Yes or no? And if yes, great, full steam ahead. If no, okay, at least we know. On to the next idea. I realize exploration is rarely that black and white, but you can plan programs to be decisive. It might cost more upfront to be thorough, but it saves in the long run by not dragging out the maybe indefinitely. Sixth, reteach the market what BeMetals actually is. This ties together all the above points and brings us back to the narrative. After doing the above, picking a focus, setting a timeline, disciplining the project list, etc., the company needs to communicate its identity clearly and consistently for multiple quarters in a row. Right now, if you ask 10 people, what is BeMetals, you might get 10 different answers. That's a problem. The company must define itself in plain terms. Are we an explorer, high-risk, high-reward drilling play? Are we aspiring to be a developer, taking a project towards mining? Are we primarily a gold company or a copper company? Or are we a project generator, platform that will spin out or deal off assets as they mature? Any model can work, but investors need to know which game we're playing here. Once you decide, hammer that message home. Hell, hire a CEO who is actually known for delivering on that kind of message. If, for example, they decide we are now a North America-focused gold explorer with our flagship in Ontario, then everything, website, presentations, interviews, should emphasize that, again and again, quarter after quarter. It might sound repetitive, but that's how you drive the point home. The market has a short memory and gets easily confused by change. You have to be extra clear and repetitive to recondition that understanding. Clarity compounds over time. A year of consistent messaging can do wonders for how a company is perceived, and perception, especially for juniors, often becomes reality in terms of valuation. So that's my blueprint for BeMetals or any company in a similar spot. One project front and center, a real timeline of what happens next, fewer projects executed with more intensity, proactive leadership even during transition, visibly leveraging big partners, delivering a clear yes-no result on a key test, and broadcasting a simple identity to the market. None of that guarantees success. You still need the geology to cooperate, but it vastly increases the odds of creating shareholder value, either through a discovery, a project advancement, or at least a market sentiment turnaround. Now, stepping back, let's compare these two companies, XXIX Metal Corp and BeMetals Corp, and tease out the broader lessons for us as junior mining investors. It's not that one company is good and the other is bad. In fact, I think both companies are run by smart teams and hold real potential in their portfolios. But they illustrate how different structures and strategies can lead to very different outcomes and expectations. The outcome so far? Clarity has compounded faster than pedigree. XXIX's clarity of mission has allowed its progress to translate into shareholder value more quickly. BeMetals' pedigree and strong backing, while keeping it alive and well-funded, pedigree absolutely bought time for BeMetals, has not yet translated into equivalent shareholder returns because that time wasn't used to produce a singular result. It was spread across many initiatives. Pedigree and money gave BeMetals endurance, but clarity and focus are what allow a company to capitalize on the time and money it has. It's like two runners in a race. One, XXIX, had a clear lane and paced themselves steadily toward the finish line. The other, BeMetals, had a bunch of extra energy drinks, money support, and tried to run in multiple lanes at once. They didn't crash, thanks to those energy boosts, but they also haven't crossed the finish line yet because they zigzagged along the way. They might still finish strong, but they've taken a more circuitous route. For us as investors, the comparative takeaway is, always examine the structure and strategy of a junior, not just the projects. A great project in a messy structure can languish, while a good, not even great, project in an excellent structure can flourish. Ask, is this company built in a way that increases the odds of success? Does it focus on its strengths? Does it manage risk smartly, like how XXIX leveraged brownfields and incubator knowledge, or how BeMetals leveraged JV partners? Points for that one. Does it avoid unnecessary complexity? Is the management adapting as the company grows? We see XXIX did adapt and narrow, whereas BeMetals perhaps took longer to adapt and is now in that process after some delay. Ultimately, I believe juniors fail structurally more often than they fail geologically. Many times the rocks do have value, but companies still fall apart because they ran out of money or diluted shareholders to oblivion, or management chased too many ideas, or refused to let go of bad ones, or simply didn't have the right team when the project matured. The geology can be fixed or figured out more often than a broken corporate structure can be. I want to wrap up with a framework, a few questions or a mental checklist that I personally use and that this tale of two companies reinforces. Whenever you're evaluating a junior mining stock, or honestly any early-stage company, ask yourself, who is backing this company and why? Are there credible people or institutions involved, and what's their motivation? Backers can provide a lifeline and validation, like B2Gold did for BeMetals, or Ore Group did for XXIX, but also consider if that backing comes with focus or just deep pockets. Understanding the nature of the backing helps gauge the company's stability and the pressures it might face. Does the structure match the ambition? If a company claims it's going to find the next big copper mine, is its structure, capital, team, approach set up to actually do that? In 29's case, the structure, brownfield projects, phase studies, appropriate management match the goal of becoming a mine developer. In BeMetals' early case, the structure, many projects, spread out focus, was perhaps at odds with the goal of making a discovery quickly. It was more like an incubator itself, but within one company. A company can have huge ambition, but if the structure is flimsy or misaligned, that ambition might remain just a dream. Is management evolving with the asset and stage of the company? The team that's great at making a discovery isn't always the team to build a mine, and vice versa. Did the company bring in the right expertise at the right time, like 29 did? Or is it stagnant, with the same folks doing the same thing even as circumstances changed? Also, are they introspective enough to know when to step back or seek help? A management team that can transition roles, bring in new blood, or make room for different skill sets is a huge green flag, one that clings to power or doesn't adapt. Red flag. If you can answer those 3 questions confidently, you're a long way toward understanding whether a junior is worth your money and patience. A company might have the hottest drill hole in the world, but if it fails these structural tests, it could still burn you in the long run. Conversely, a company that has average drill results but great backing, proper structure, and adaptive management might surprise you with how far it goes. For me, applying this framework to our 2 cases, 29 Metal Corp checks all those boxes in a positive way, which is why I'm comfortable increasing my stake. It has solid backing, ore group, and insiders who are committed, a structure perfectly suited to its mission, tight focus on building a mine, not wandering aimlessly, and a management team that evolved when it needed to. BeMetals, on the other hand, has great backing and people, pedigree check, but its structure has been a work in progress, broad focus that is now, hopefully, tightening, and its management evolution is happening a bit late, only now going through that transition and refocus. That's why it's under heavier scrutiny in my portfolio. I'm not bailing, I still hold it, because it could right the ship and sail ahead strongly, but I need to see it before I commit more capital. I'm essentially saying, I love the potential, I respect the people, but show me the progress, and then I'll consider doubling down. Until then, I'm in wait-and-see mode. In the end, if I had to bet on which structure survives and thrives over the next 5 years, today my bet is on the one that's already demonstrating survival skills. The focused, disciplined builder, 29, over the broad, rebooting explorer, BeMetals. But I'm rooting for both, because if BeMetals pulls off its turnaround and hits pay dirt, that's great for everyone, including my portfolio. It's just that as of now, one is clearly the tortoise steadily making progress, and the other is the hare that took a scenic route and is trying to get back on track. To close out, remember that in junior mining, clarity and structure tend to get rewarded faster than pedigree and promises. Pedigree can buy you time and keep you in the game, as we saw with BeMetals. But if that time isn't used to create clarity and results, the pedigree alone won't carry the day. Before you put your hard-earned money into any junior resource stock, take a moment to look beyond the glitter of the project. Ask those 3 questions from our framework. Most juniors don't fail because they ran out of minerals. They fail because they ran out of money or cohesive vision. Essentially, the structure cracked before the geology ever got a chance to deliver. That's it for this week's deep dive. 2 companies, 2 different paths, and a lot of lessons in the rearview mirror. As for me, I'm putting my money where the structure and momentum are, adding to 29, and I'm keeping a close, if cautious eye on the one with pedigree under scrutiny, holding BeMetals. I'm willing to act, either direction, when momentum becomes visible and real, not just theoretical. That's it for this week's dig. If you want more deep dives into the miners making moves, don't wait for the next episode. Get the data yourself at juniormining.gold. They are the leading edge for junior resource investors who want the truth without the fluff. I'm Dusty Nugget. Stay bold, stay scrappy, and I'll see you at the next drill site. You can learn more at juniormining.gold. Please like, subscribe, and visit our socials or our Substack for more content.